In August 2024, the global financial markets suffered a sudden, violent crash. In the United States, portfolios and 401ks shed billions in value, even though there was no domestic economic crisis to trigger the sell-off. This instability originated 6,000 miles away. Your 401k, your stock portfolio, and even your mortgage rate are tied directly to the Bank of Japan. For 30 years, the global financial system has relied on a hidden engine, an endless supply of free, borrowed Japanese yen. That engine is now being shut down. Japan is preparing for a multi-trillion-dollar capital repatriation, pulling its wealth back inside its own borders. A withdrawal of that magnitude risks a systemic collapse. Consequently, the U.S. Treasury and the Federal Reserve have begun alerting major banks to prepare for coordinated market interventions to prevent a broader liquidation. To protect your own wealth, you have to understand the mechanics of this 30-year-old financial loophole and why it is currently unraveling. Japan has spent decades as an economic anomaly. To fight off deflation, the Bank of Japan held interest rates at 0% for 30 years, making money essentially free to borrow. In the yen carry trade, global hedge funds borrowed yen at 0%, converted it to dollars, and bought U.S. treasuries paying 5%, pocketing the risk-free spread. Japanese institutions did the same, shipping domestic savings overseas to find yields that didn't exist at home. Because of these massive capital flows, Japan became the single largest foreign holder of U.S. government debt on the planet. For decades, this endless injection of Japanese capital helped keep American borrowing costs low and global asset prices high. The math changed after the 2022 inflation shock. While the United States aggressively raised interest rates to 5% to cool the economy, Japan, burdened by a debt-to-GDP ratio of over 200%, held its rates at zero. Capital violently fled the yen in favor of the higher-yielding dollar. With no one left who wanted to hold Japanese currency, the yen's value began to crumble. The collapse was so severe that the yen fell to its lowest valuation against the dollar in 40 years. The last time the exchange rate looked like this, Ronald Reagan was in the White House. Tokyo faced an impossible dilemma: allow their currency to hyper-devaluate, making imports unaffordable, or raise interest rates to save the yen, a move that would devastate their domestic bond market. Japan finally moved to intervene. They raised interest rates, which instantly erased the interest rate spread that allowed the global carry trade to function. By pushing interest rates above zero, Japan inadvertently detonated a multi-trillion-dollar global leverage bomb that had been building for 3 decades. Capital is now returning to Japan. For the first time in a generation, Japanese government bonds are paying a yield, giving domestic investors a reason to bring their money home. The Japanese government has signaled to its massive institutions, like the $1.8 trillion GPIF pension fund, to start shifting their investments away from foreign markets and back into domestic assets. The mechanics of this reversal are straightforward. To buy their own national bonds, these funds must sell their foreign holdings and convert those dollars back into yen. Defending the currency in this way triggers a massive systemic withdrawal of liquidity from the global financial system. For America, the consequence is direct. Japan is now forced to dump its massive stockpile of U.S. treasuries to fund this repatriation. When the world's biggest buyer of U.S. debt becomes a seller, the U.S. government must offer higher interest rates to attract new buyers. These rising treasury yields dictate the cost of living for Americans, the benchmark for 30-year mortgages, credit card rates, and corporate borrowing costs. We saw how quickly this can damage the market. In August, a minor rate hike caused the Japanese stock market to lose 12% of its value in a single day. The global financial system is sobering up from a 30-year bender of cheap credit. To navigate this shift, investors can no longer just watch the Federal Reserve. They must watch Tokyo.